Good afternoon. So before we get started, I would like to introduce the rest of the panelists today. So starting on the end, we have Margaret Wren. She is the chairwoman of Bank of America's Asia Pacific Corporate and Investment Banking Unit. In the middle, we have Jean-Yves, who is the CEO of BNP Paribas USA, and Ketan Patel, who is the CEO of Greater Pacific Capital. So thank you all today. We have the opportunity for the next 30 minutes to step back and look at the global macro backdrop that is so relevant to the decisions that we all need to make, either as investors or advisors. And to set the stage for the discussion today, I want to play just a short clip that identifies some of the longer-term trends that we at NatWest Markets believe are going to be particularly important when it comes to thinking about future investment opportunities. So with that, can we roll the videotape, please?
Demographically, the world is getting older. Populations are aging. By 2050, global life expectancy is forecast to rise from 71 years to 77 years. By 2030, the middle class will be 60% of the total global population. Of the next 1 billion entrants to the middle class, 88% will be in Asia. These have implications for not just higher consumption and higher savings needs, but rising demand for fixed income product, and also likely need for innovative insurance solutions, changing needs for the medical industry, potential infrastructure needs if the world continues to urbanize, etc.
We are seeing a significant rise in global populism. You see that across Europe, you see it in the US, you see it in lots of parts of the emerging markets, and I don't think it's controversial to say that populism tends to be inflationary. And I guess related to that, we're seeing really for the first time in more than a generation a move toward deglobalization and a lot more focus on trade protectionism.
Over the next 10 years, trend global growth is widely expected to slow from 3.7% in 2018 to under 3% by 2030. China will have overtaken the U.S. as the world's largest economy. Income inequality has been rising across the globe, and looking forward, demographics and automation will further exacerbate this trend. Indeed, the collision of demographics, technology, and income inequality may usher in a new era, one where governments expand their role using higher taxes and regulation to address imbalances.
So there's certainly a lot that we can talk about in terms of the longer-term trends. But before we go there, I want to get each of your perspectives on the here and now and what you see in your respective regions in terms of kind of the current state of affairs. So Margaret, I want to begin with you because China, of course, is always a central point of interest. Earlier this year, there had been a lot of concern about growth in China, the potential for a hard landing. I think the data have improved, and some of those fears, I think, have moved to the sidelines. But can you give us your view on current conditions in China?
Yeah, regarding China's economic situation, let me put aside China-U.S. trade war for now. I will start with a brief review about, in the past 3 years, China's economic situation. From 2015 to 2018, and at that time, due to the fact that a lot of Chinese companies' debt default rate was increasing, and also a lot of companies was on the edge of was on the edge of making loss. Chinese government initiated supply-side reform, issued stringent policy across the board. So, for example, for the material sector, and there were a lot of huge overcapacity and also heavy debt. Chinese government initiated decapacity and deleverage in the sector. Material sector in China accounted for 8 to 9% of total bank loan and about 10% of corporate bond. For example, on steel, China produced 50% of world steel with 1.2 billion metric tons. For past 3 years, China has cut down 150 million metric tons, which is about 13% of the total capacity. This led to China's steel sector's price being re-rated. For the real estate sector, Chinese government was curbing financing for the developers and also controlling selling price and the demand. For the financial sector, Chinese government was cracking down on shadow banking and also cutting down off-balance sheet financing. And for the public sector, all at once, Chinese government implemented a very strict environmental standard to cut down polluted factories. And also in the private sector, Chinese government cutting down bank loans and also funding sources, tighten credit to privately owned enterprise, and also regulate whether you are a Macau casino or internet gaming company or biotech companies or pharmaceutical company making too much money on the generics. Due to all these strict measures, China's credit growth came down from 16% in 2016 to about 10.5% in 2018. And China's investment growth came down from 20% in 2013 to about 6% in 2018. So we see China for the past 3 years has gone through a policy-driven economic slowdown. This year, the situation has changed. The Chinese government has stopped decapacity, which is entering into consolidation phase. Deleverage has reversed, and the Chinese government is pushing banks to lend to SMEs and privately owned enterprise. On the fiscal side, the government has announced income tax cut and also reduced the government charged levy to further reduce the burdens for the companies, which is amounted about 485 billion US dollars. On the monetary side, the PBOC has already cut 5 times reserve requirement ratio, lowering to the large banks about 13.5%, the ratio lowered, and then lowering to the smaller and medium-sized lenders to about 11.5%. Just about 3 days ago, the PBOC cut 6 times and to about 1,000 rural commercial banks. The ratio lowered to about 8%. Due to all these easing measures, on the first quarter, China's economic situation has shown broadened improvement, with GDP growth at 64% year over year and versus market expectation about 6.3%. So we do believe the worst is over and China is able to achieve 6.3 to 6.5% GDP growth this year. Of course, there are outside factors and US-China trade situations, which I didn't elaborate. But with the domestic situation, we do see China is stabilizing and the hard landing gets under control.
So I think that is a really important point. You talk about the factors that led to the slowdown, the deleveraging policies that have since reversed, because I do think that there are, many people who looked at the slowdown in China and attributed it to the trade war, and that what you're saying is that it was much more organically or domestically induced, and the actions policymakers have set the stage for better growth going forward, or certainly hitting the targets. And I know you didn't want to touch too much on the trade war. We could talk all day about the trade situation, but I just do want to ask you, if there is no trade agreement with the U.S., would that impact the kind of the optimism or the confidence you have in China meeting its growth targets? Would that potentially create risks, or do you, how contingent is your short-term outlook on whether or not a trade agreement is reached?
Yes, statistics show that since the trade war started last year, China's export to the United States still tracks towards the rest of the world. But however, the import from US has decreased significantly. In January, it was decreased about 40% year over year. And actually, the deficit between the US and China is not decreased and even increased. And in 2017, US and China deficit was about 376 billion US dollars in 2017. It actually increased to 419 billion US dollars in 2018. So actually, trade war in the short term is much more a confidence issue, and to the actual impact. It's just started on the first quarter, we can see, but so far it's still manageable. Of course, trade war is a small component of a large picture, and there are basically long-term broad-based competition between US and China, and which probably potentially could be a new norm. But it seems to me that both sides still wants to have a strong desire to have agreement, and both cannot afford to have a no-deal situation.
Well, then let's bring it over to the U.S., the other side of the trade dispute. Jean-Yves, obviously running the U.S. Operation, what do you think about the state of the U.S. markets, U.S. economy? How do you see things?
Well, first and foremost, thank you so much for having me. I look forward to this dialogue with you, with my colleagues here. And I think, what Margaret just highlighted, irrespective of the status of our respective regions, I think it's all interconnected, and that's something that has to be highlighted. I love the video, by the way. And maybe what I would like to do is maybe highlight a few trends and comment on how they link to the US economy today. One that is quite important, which the video highlights very well, which is this growing middle class. And really for the US, it's been positive because growing middle class, more savings, more interest across the world in fixed income assets, and it's been fueling, inflows of capital into the capital markets here. Fixed income assets, name them, treasuries and leverage loans, and a lot of these assets have highly benefited from this trend, and I think it's supported the US currency as well, and I think it's been part of the supporting quite significantly the expansion we are still experiencing in the United States. There is a second interesting point about government intervention. I would say in the probably one of the most capitalistic economies economy in the United States, it's the case as well. But constructively, tax cuts, repatriation. I think we're still running a fairly large, fiscal deficits, and government has been supporting and fueling this economy, which is, still growing. And even regulators, by the way, have adapted across many industries. Name them: energy, housing, healthcare, just to make sure this dynamic would still exist as it relates to our industry, banking. Even the regulators have as well tailored, adapted to make sure the banking industry can continue to fuel. Then, and the third one, which you touch upon as well, it's so, I would say, thoughtful, is technology. Obviously, technology is around the world, no question about it. But I would say the US remained the birthplace of a lot of innovations. Data, mobility, digital. We have a strong presence in California, Silicon Valley, and I think that's been fueling the economy over the last few years. I think that might be fueling the next stage of expansion. Then status of the U.S. economy, whether you look at different points, job creation, low inflation, the corporate fabric is in an amazing shape, a lot of liquidity, vibrant capital markets. That's pretty much all good, with the caveat that we are all interconnected.
Right. Given how your generally positive view about the U.S., can I ask you, in terms of interesting investment opportunities, I mean, what are some of the things that you think right now look particularly attractive as you kind of talk about some of these trends and their impact?
Well, in terms of like short-term
Yes.
focus here, and really for probably the audience we have here around asset managers and hedge funds, I would definitely focus on local markets worldwide. In a global world that it's still global today, we see some balkanization from fragmentation, some deglobalization, I guess, and I think focusing on local markets is something which I think can be really attractive and provide return. Obviously, to do that, you have to have probably local teams or rely on local advisors. Being present in 72 countries, BNP Paribas, having done it for decades, I can measure the challenges, but the opportunity. The second piece is around diversifying probably strategies. Beyond the classic macro fund strategy, I can see a lot of opportunities still in lending directly to the economy, name them infrastructure, project finance. Banks are quite active, but because they are regulated, because they are at times risk-weighted assets constrained, there is a lot of space still for the asset management, hedge funds dimension. And there is one I would like to touch upon, which maybe we'll discuss a bit later, which is sustainability.
Yes.
I mean, I'm sure our colleagues here in the audience feel really directions and at times pressure from endowments, from pension funds, in terms of them raising the bar. They're raising the bars in terms of what they want to see in terms of sustainable strategy and assets. And honestly, I think this is the part of the future. Last point I wanted to make here, which is maybe not strategically linked, but efficiency. We all have to run P&Ls, right? In a place where fee structure and squeeze margins are pretty much the day-to-day. Running leaner operations, working on the P&L, implementing digitalization, automation, which the bank is very well positioned to advise across the spectrum. Execution, clearing, prime services, data, management of big data is something that actually is an opportunity as well.
Really important. Well, Ketan, I want to bring you into this conversation. Sure. Obviously, Greater Pacific Capital has a big focus on India, but you also have a global perspective, sure, and your business is about taking the opportunities in India global. Tell us about how you see the world.
Okay. It's a big question. So we look at it and we look at the growth overall. People are now talking about 0 growth or 1% growth. But in our part of the world, in Asia, as you heard in China, it's 5 to 6.5% growth. In India, 8% looks like the floor the country is putting it at, right? So they expect to cross 10. So someone is obviously delivering minus, and it's not just the Japanese, I would guess, but someone's heading for minus while we're heading for 10. So with that backdrop, I think one of the keys to what's happening worldwide is populism. You had it in your introductory video. And I think it's an important key because it's very different between the West and the East. So in the West, you see it in the streets of Paris every weekend. You see it in London with these big marches for Brexit. You see it in the US. There's a lot of anger. And so populism is defined by this anger of people who feel they have not benefited from the foundations of our capitalism. In the East, it's very different. It's people who have never got to participate, and that's the mass population, who have hope and feel that this is their time to participate. So in the East, it's about inclusion. And what you see is governments, whether it's Chinese governments who are not elected in the sense that we look at elections, they have their own system of election. You look at India, where it's a massive popular vote happening right now, it's all about inclusion. And so in the last 4 years in India, we've seen 300 million bank accounts opened. That's enormous, right? You could not pull that off in any democracy or maybe an autocracy overnight. And most of that was achieved within 2 years. You've had 600 million people get critical Medicare, and the program only started last year. So, in the West, we're arguing ideologically in places like America even about whether Medicare should be provided. But in India, it's considered to be a human right that we haven't delivered. And so the program passes. So you have a series of inclusion-driven changes which are really driving the economy and the energy levels of the country.
But then, so what are some investment opportunities when you talk about some of these trends and the difference between the East and the West? How do we position, particularly for the growth that's coming in India?
Sure. So in India, clearly, a lot of people would have been disturbed by the last 5 to 10 years. So if you break it down, India had 50 years when it was just agricultural, socialist, and not really delivering. The growth rates were 2% or so. And then you had, so it's 50 years to get to $1 trillion of economy, of GDP. And then you had 7 years to get to 2 trillion, 5 years to get to 3 trillion. So if you plot that curve, you see this massive rise. And so this inclusion is what drives it. Also massive urbanization, where 70% of the population is leaving the farms and coming to the cities. So the way we look at it as an investment firm, we say there are 5 inclusions that are driving this opportunity for investors. Financial inclusion is one. As I said, so many new bank accounts opened, insurance policies and so on. Healthcare inclusion, this Medicare program plus just the demand for healthcare generally is really growing. Digital inclusion, so for the first time people are getting smartphones to transact, not just to make phone calls, and this is a mass phenomenon now almost. Educational inclusion, so a few 100 million people for the first time will get education of a decent level. And then workplace inclusion, so a country like India had 90% of the people were paid cash in the hand. So as that changes and they put the money into their bank accounts, they join a formal economy. So these 5 inclusions drive the economy to a complete different place.
Well, so that's interesting. Margaret, I want to pick up a bit with you because we've talked about the fact, and you've said that the trends and the factors that will drive investment in China in the years ahead are going to be very different than what we'd seen over the last 3 decades. So can you take us through that? What are some of the factors that you think? We've heard about inclusion and what those policies will mean, for India. What about China and the factors that will drive investment there?
Yes, prior 3 decades, China's growth is basically capex heavy, property-driven, and resources-intensive growth, and those is about to come to an end. So the new driving factor is basically could be like 6 factors. Number 1 is technology and innovation, which government is very pushing and give a lot of policy treatment. And then on the technology and innovation side, including AI, machine learning, biotech, and 5G development and autonomous driving. Those are very focused area. China has 7 million graduates every year, and all the Chinese young people are geared to basically to be more innovative and to learn, STEM and try to be entrepreneurs. The second driving factor is really new energy and clean environment. So basically, China's primary consumption currently is 58% of coal, came down from 63%. China's aim to decrease coal to 56% in year 2020. And the oil stayed at 14.6%, which will stay flat in year 2020. China consumed about 630 million metric tons oil last year, and 70% were imported. And then the renewable energy and the gas, basically China will increase dramatically. Currently stay at 8%. It will increase to about 15% in 2020. China imported dramatically, like a 46% increase in 2017 on LNG. In 2018, increased 40%. So basically, the focus on clean energy, renewable energy, is also one of the driving force. The third driving force is really middle and affluent Chinese consumers, middle class, wants to have more quality of life, and then food safety and vanity capital, and also brand consumption are all a key focus and driving factor.
Well, we had talked about in that video that of the next 1 billion entrants into the middle class, 88% are going to be in your region.
Yes,
so
and the fourth area, of course, with the Belt and Road investment, infrastructure investment spending, and the fifth area is like when Chinese people start to age, the demand for financial products, asset management, financial planning are also very huge. So basically, those could be the new future driving force for the investment opportunities in China.
In the region. Jean-Yves, I definitely want to come back to you because one of the other themes, of course, is the aging population and boy, what that means for the need for sustainable development and sustainable financing. And you had talked about that. And of course, BNP Paribas is a leader in that area. The European banks are a leader. Can you talk a little bit expand a little bit more on some of what's happening there?
Sure, absolutely. You're right, Michelle. BNP Paribas is a firm believer in sustainability to the point that we have actually embedded in our client strategy and product offering the United Nations, Sustainable Development Goals (SDGs), to make it part of the day-to-day life in our business. Journey. For instance, we offer to corporates now debt packages which cost of funding is actually linked to the client, meaning the borrower, meeting or exceeding their sustainability metrics. Meaning if they do exceed or meet or exceed, basically the cost of funding comes down. Right. Then that's really, you cannot believe the level of interest and appetite we have from clients. On the institutional side, the World Bank recently, last week, actually, their treasurer announced that, by 2020, actually, over 30% of their, focus and assets will be in sustainability. And we've been one of their most active banks in terms of underwriting their bonds and coming up with some quite creative structures involving, sustainability concept. Then I think for our audience here, this is, I believe, an amazing opportunity for investing. Just some numbers. If the UN is basically forecasting that to meet their goals by 2030, and it's on a good way, there is a need for financing investment of anywhere between 5 to 7 trillion annually. By the way, the level of savings worldwide today is probably 3, 4, 5 times this number, meaning it's very possible. But I think this is our collective responsibility, banking, asset managers, alternative hedge funds, to basically come up with the right product solutions to redirect some of these savings into the right place. And I think it's happening, but it's not only doing it for the sake of the planet and for the sake of being socially responsible. I think it's, I believe whoever stays aside of this might not be part of the future. There is something I firmly believe in is finance is a forward-looking domain, right? And I think if we believe that, we not only do what we do for profit, but we do it as well because we believe in people and we believe in a better world and in a better planet. And I think that's very strong here.
Your passion comes through, and that's why I absolutely wanted you to have an opportunity to talk about that. We've got just a short time left. I mean, if we step back and talk about or recap what we've said, I hear generally upbeat, whether it's China, the U.S., India, where 8% plus growth is the floor. So, and in parts.
I hope so.
I guess in the final minutes, maybe we could just go down the row and everybody. I'm curious to see if there was something that you felt that would be the biggest risk, something that you're watchful of that might change sort of the upbeat view, or I guess conversely, is there something that we haven't talked about, because of course we've only had a short time, but you don't, in the broader conversation, let's say, about the macro landscape, is there something that you don't think people are talking about or focused on that they should be? So maybe we could, each go down and share either a risk or some area that deserves more focus than it's getting. Margaret, do you?
Yeah, I think probably two aspects. One is the geopolitical situation definitely become, increasingly important to everybody. And it seems there was always crisis here and there. So look like it's more intense than ever before. So which we always need to watch for potential, situation. The second thing is about inequality. And of course, this is like a lot, basically all the developed nations are aging, high debt, and also in the inequality situation. This need to be further addressed. Otherwise, it could be a lot of like riots and also a lot of potential crisis.
Yes. Yeah, growing inequality, I think, is a theme. We won't be able to get too much into it, but when we talk about what's driving the populism, what's driving even some of the trends toward deglobalization, a lot of that, I think, comes rooted back into kind of growing inequality. How about you, Jean-Yves? Where do you either see risk or?
I would say, unfortunately, I could not agree more with Margaret. I think, geopolitics and geopolitical events are there, and really the global markets and economies do not like uncertainty. No question about social inequality, and I think we see it across the world, by the way, right? For maybe different causes, different reasons, but it's there. I would maybe add one that you started with, but you're an optimist. You'll be challenged to get negative things out of me. But it's a fact. I think all the trade discussions, and by the way, way beyond U.S.-China, it could be U.S.-Europe, it could be are factors of uncertainty and potentially of unpredictable volatility.
Yeah. How about you, Ketan?
I think the geopolitical one's important, but I think we have to ask as investors, why right now are so many disruptive leaders running the world? Why is it right now? And even in democracies, why is that happening? Why did people vote for a Brexit? Why did they vote for Donald Trump to do this? And I think it's because there is a massive shift in the world going on right now from an industrial civilization to an information civilization. And so the old things that defined our values about how we trade, how we do business with each other, what kind of jobs we get, what security, how much we should be paid, those things will not be valid as we transition. And in this transition, we want the same things we wanted before, but we can't have them. Just as we couldn't have them from agriculture to industrial, we can't have them. So we're voting for people who tell us it will be fine, and they will fight for factories to remain open, and that can't happen. Because as China's shown and the rest of the world is showing, you have to automate all these factories. So what are you going to do with these people? So we're in a transition that is very profound, and in that profound transition, Americans feel uncomfortable. So do Europeans. Asians feel optimistic, but their time will come to feel uncomfortable too. So that's the negative, I think, of the context. But it's a transition. Ultimately, we will transition to something else that's more positive. But we're in the transition now, and it feels uncomfortable.
That is definitely a different way that I've heard people talk about. So a fantastic way to end with something, again, that people aren't maybe focusing on, this transition. I just want to thank each of you for the comments today. It's been great to be able to be up here with you. So thank you very much. And with that, I think we can finish our session.
Thank you.
Good afternoon.
Thank you.